Good afternoon, everybody. How you guys doing? Hey, Jen. Does your family know you're rich? Do you get cousins or aunts asking for money? No, not really. I don't really talk to anybody in my family. At least not my extended family. What's up, Crackle? Oh, I am hungover. I stayed up till like 4 in the morning making eggplant parmesan and drinking whiskey. Thank you for laboring on Labor Day. I'm utterly flabbergasted by my 24-hour timeout on the Discord server. I accept your terms. I warned you. I'll take your plea into consideration. Does that make us more your family than your real family since you talk to us around 38 hours a week? Don't remind me. Happy day, Gurk and Pickle Familia. Happy day, Northern Cowboy. How's everyone doing? I've been trading futures most of the morning. It's been pretty fun. Russell took a big fat dive. I wish I'd gotten a position on ES too, but I did catch the dump on Russell. And I need VIX to move up one point. That would be really cool too. I was hoping to sell Delta at time and a half today, but the orders won't go through. Theta, yeah, well today's the market's closed because of the holiday. HSI ripped, I think, like 200 BPS or something last night. Went up quite a bit. Held its gains for a change. But, China's literally doing everything in their power to try to keep people from fleeing their markets. What's up, Dr. Cyborg? Dr. Cyborg. Doing great. Also, 12 months. What the duck? Happy anniversary. Should we expect to open Bigly Red tomorrow? This is what? I think this is like 45.15. So I think we're trading at roughly the same fucking price we closed at. Actually, yeah, we are. So the over the weekend move, faded out, but yeah, we're not really doing much here. If the market's acting this way today because it's closed, what was the market's excuse on Friday? Well, the data wasn't particularly great on Friday. So, we failed the big breakout and then recovered a bit into the end of the day. If the market is, I mean, it wasn't particularly exciting. Actually, the open close variance day over day on ES has been shit for the last like 3 days, right? I guess it's actually opened higher. So it's been pretty awful. Which is, yeah, helps drive VIX down. But VIX is up 5.66% today, and VIX futures are up 70 BPS. So starting to move a little bit, although VIX futures are massively. They're not. The forward curve on VIX isn't pricing in any volatility till like, well, ever. um, it's pricing in like 16 for October, 17 in November, 1750 in December. So as far as the VIX is concerned right now, nothing is ever going to happen again. Well, Leather Jacket Man did that thing he did. Oh yeah, Jensen. He exercised and sold some shares. Probably not the best time to, like, it wasn't a lot of shares. He owns a shitload, but most of them aren't owned directly. They're owned through trusts, but um of his like direct holdings, 250,000 shares is a lot. Um I think it was like a notional like 100 million. I think the bigger issue there though is like the PR, like choosing to do it now, um when all this like CoreWeave shit is blowing up. Not a good look. It seems consumer weakness is starting to hit the news cycle after retail earnings were signaling poor forward guidance. Yeah, but still kind of on the back of that big surge in consumer spending in the early part of summer, right? So even though like consumer like surveys are showing some weakness, and retail and discretionary spending are as well, the data is not going to be really bad for like another month, right? So it'll probably be mostly ignored. Why not sell the top? Oh, I agree. The last time Jensen sold, Nvidia did nothing but tank for an entire year. Remember, our fantasy football draft is at 3 p.m. Your team's name is still AMC to the moon. No, not only would I never play fantasy football, I would never actively promote anything AMC related. Good job, Carl. You got him. I wish you'd gotten him before he said that, but it's okay. Anyway, so the inability for the market to break higher than gamma neutral over the course of last week was pretty bearish. Um, Hold on one second. I'm gonna open up some goodies here. Why is that not fucking loading? Ooh. Yeah, so gamma neutral looks like it hasn't been fucking updated yet. So we'll find out about that, more of that later tonight. Hmm. Just want to take a look at call interest for tomorrow's expiration. All right, so tomorrow's expiration, there's still some intermittent interest up to like 45.40, and there's still some in the money calls at like 85.90 and 95, and a bunch at 45.15. Although on either side of 45.15, it's pretty evenly weighted between calls and puts. And a fairly significant amount of the out of the money call ladder broke down on Friday with the date when the data came out. So if you'd been following along, a bunch of call interest came in between Wednesday and Thursday to the upside, like a pretty decent call ladder, um, that extended up to about 45.50. Um, Much of that appears to be gone now. 45.50 still very sold, but the call ladder up to that strike is no longer as robust as it was. So 4,500 is still moderately well defended, but not as well defended as it was last Friday. And put interest and a put ladder are starting to accumulate to the downside of 4,500, beginning at 44.95, with a few intermittent in the money call walls that would prevent any rapid decline. But if we open under 4,500 going into tomorrow morning, that's going to be pretty bearish, at least the way it looks right now. I would imagine with the increase in put interest on Friday, we'll probably see gamma neutral move up a little, but I need to see the rest of that options data before I come to any other conclusions. I do know that like bot call interest was starting to fall off going into Thursday night, after the first failure to break above gamma neutral. Will the end of summer slow down, overpressure the market, and force a crash? Or crashes priced in and impossible due to liquidity? I mean, crashes aren't impossible, and the current environment is not very liquid at all, which increases the chance of a crash happening. Although remember that chance is always very, very low. Um, but yeah, I mean the environment's not extremely liquid right now. There are liquidity issues. Credit spreads have been widening over the last week. Dollar values, well, credit spreads are tightening. Bond spreads are widening a bit, and dollar value has been increasing pretty consistently. We can take a look at that. But through most of the middle of the week, we saw a big drop in yields and a decent decline in the dollar up until Friday's unemployment data, where we saw yields move kind of back to the range they were in on our bigger drop. And we saw the dollar move back up above 104 pretty quickly on Friday. Remember that this increases risk in risk assets, and also increases volatility not only in equity markets but in bond markets as well. So if the dollar continues to move up, we're probably going to see continued upside pressure on volatility, which makes volatility harder to keep down. And it is one of the reasons that we didn't move back to like our previous highs here on SPX, despite the fact that more pressure was thrown into this run than even the prior ones. The performance of the VIX shorting and long zero DTEs was significantly worse than it had been in the past. VIX dropped from 18 to 13, and in the course of what, 5 days, over 5 days. And at the end of that, we only really got like 230 basis points. Whereas, if we look back at other prior pumps where vol was heavily shorted like this, the performance, like for instance, this was like 480 bps. If you go back to May, it was like 430 bps on similar dives and volatility. So the returns are greatly diminished from where they were even just a couple months ago. My testicles are gigantic, Bob. Thanks for asking. I could use some shrinkage. Bearish enough to be bullish? No, not really. Isn't it most likely that Jensen scheduled his stock sale long before the CoreWeave thing? Not necessarily. I mean, if he's selling now, it takes like 3 days to schedule those sales. So the CoreWeave thing, it would appear that they have given CoreWeave chips, which CoreWeave has then used to collateralize loans to pay them back for those chips. But now CoreWeave is in the position where they need to sell cloud time on the utilization of those chips in order to maintain the interest payment on the loans that they use to pay back Nvidia. Right? So which are collateralized, those loans are collateralized with the chips that they got from Nvidia. Some people would say, oh, that's fraud. One could make that assumption without knowing all the details. I doubt it's actually fraud. But it's not a good look to have a AI chip Ponzi scheme. What kind of smartphone do you have? Samsung? I don't like Apple's iPhones. I'd probably just get the Android. Usually when I upgrade, I just buy like whatever the best Android is at the time. Loophole fraud, as in legal, but just barely. I mean, they found a financier that's willing to collateralize the value of what's very likely a depreciating asset. So, but if that fails, it's going to fail spectacularly, right? Like if they're unable to sell a sufficient amount of cloud time, which they're already discounting, then they're going to be unable to pay their loans, right? Which means that the hardware is going to get seized or liquidated in order to, but then Nvidia is still on the hook, right? Yeah, I don't necessarily agree with that video. I saw it, but I don't think it's very well researched. And CoreWeave's a private company, so there's a lot of data which there's no public access to. But if they're doing it with, I think the broader idea is that if they're doing that with CoreWeave, they're probably doing that with all the startups that are buying them. Like, that video jumps to way too many conclusions that are kind of hard to prove. But the CoreWeave sale makes up a significant portion of their quarterly revenue for this last quarter, which they beat, right? And then one begins to question how much of their revenue this year and forward projected revenue is based off of similarly structured deals. And that's and now you have the CEO selling on top of that. That's not going to be, that's not going to leave a great feeling in for shareholders that just bought the stock at, between $400 and $500 a share. I'm not getting tinfoil. I specifically cut off the tinfoil direction that some of you specific people wanted to take. But yeah, anyway, um, there is definitely some questions arising surrounding their recent sales, as there should be, given that they're reporting in their non-GAAP financials sales, which have, they've yet to make any actual revenue on. Let's see. So let's take a look at GME here. So GME is, continuing to see covering. It still hasn't accelerated in any meaningful way. But we're getting closer to the point where that's more likely. Um, Now mostly trading around 1850, which is moderately significant upside resistance. The next important one being 20. Um, Now, a lot of this covering could be in preparation for earnings, which are this week on Tuesday after market close, or Wednesday, sorry, after market close because of the holiday. Um, they could potentially use this liquidity to short again, although if they do that into GME's earnings, that's going to put quite a lot of pressure on the September OPEX. So if we see a significant amount of shorting into earnings, we're probably going to see a pretty rapid covering in the following week after OPEX. But as of right now, it looks like we're just going to continue to see that trickle of covering come in, and we're still looking for the tips to touch. Upstart is continuing to be shorted. Nvidia failed to have any substantial breakouts this week, and liquidity in bots still remains okay for now. It's a little tight, but it's not crazy. It looks like they're going to continue pressuring it to the downside, unless tech has a really big turnaround. But we've kind of already discussed the lack of liquidity to the upside here, and without anything to squeeze out, and tech, like most of the big tech stocks, liquidity is being sold pretty heavily, by the bulls, right? So your buy and hold investors are selling a lot of short calls. Nvidia specifically this week at 500. I think the OI at the strike is over 100,000, which is driving the vol on the stock into the dirt. So those are likely to continue trending down, and if that's the case, then liquidity on Upstart's going to be fine as far as the shorts are concerned. They are a little bit above the level where they have a decent amount of leverage at 30, but they have a pretty solid short position at like 35 and 40 as well. So I don't think they're going to lose control of it anytime soon. Fubo, on the other hand, looks like it's starting to get some covering, and if we're going to get a big surge of Russell short covering, Fubo could definitely be a big beneficiary of that. Liquidity got pretty tight following earnings, and the short from like almost, well, we almost got to $4, but the short down from $4. It started to pick up a fairly decent number of FTDs, so they're having liquidity issues with the underlying, and then more broadly, there's covering on the Russell as well. So that means like IWN, IWO. Those ETFs are probably going to see some covering, especially if the market's going to get ready to move into another leg down. We'll probably see short covering on those before that happens. But it does look like liquidity is expanding on Fubo, and it's doing it pretty quickly, which is rare. So Fubo may have a little run. I don't know, maybe 3 or 350 again. So keep that in mind if you have covered calls out right now. This could run this week, and I really wouldn't trust it turning around unless we see it move back under like the 250 level, or maybe even 240. Is now the time to short Nvidia if one has not initiated a short on it already? You could. From a technical perspective, yes. The issue with shorting Nvidia in these price ranges is that most of the strikes are heavily sold, right? So the 500, the 490, the 480, that's actually a little lower. Hold on. This is like the 490. This is the 480 and 475. These are all like short calls, right? And if Nvidia falls back kind of to this level, right? Like 470, we're going to see a lot of these short calls get closed. And when those short calls get closed, that's going to drive the price back up. And this is something that's gone on with Nvidia for several months now. And it's something to be very, very aware of when entering short positions that are betting on, an extended move to the downside. Like if you're betting on like 450 or 400 or even further, you need a lot of theta, and you probably need a good hedge on that theta while it continues to chop around. Now, don't get me wrong, you can get a series of these pullbacks like we saw back here in the early part of August, where, large numbers of calls were sold, they were pulled back, they were sold again at a lower level, right? And then this finally started to push Nvidia into some of its put interest alongside the declining market. As earnings approached, all of those short calls were pulled back, price skyrocketed. After earnings, we saw a lot more short calls come in again. Price got crushed. Short calls got pulled back, and now they're getting sold again at a lower level. So the expectation for Nvidia right now, I would say, is probably for it to move back down. How far it's going to move down, I don't know yet. It'll really depend on how much short call selling continues in this range. People aren't aggressively bearish on it yet, although that could pick up given Jensen's sale and whatever comes of these CoreWeave rumors, right? But right now, not a lot of puts on the chain, so nothing to really accelerate downside price action, right? And so, what you're mostly going to be looking for here on Nvidia is continued short call selling on the downside. You'll probably look for a lower low somewhere in this range. Um, over the next couple weeks, and then as those short calls are pulled back, a bounce back up, but maybe to a lower high, right? And I think that's going to continue on Nvidia until something substantial breaks or they miss earnings. So I mean, as someone who has a lot of, like January and out of the money puts on Nvidia, it takes quite a lot of effort to manage that position. And it's probably not worth it to hold right now. Not yet. Um, if I was going to try and time it, although news from this kind of stuff can break randomly, and yeah, you can miss an opportunity, but the difficulty in carrying the position is pretty intense. The main issue is there's minimal options for JMA is there's minimal options pile ups, and many longs are just running CCs and not playing vol. Actually, like OI on the leap strikes has improved pretty consistently over the last 3 weeks. There is some long interest coming in, although it's not very substantial. There are not yet a lot of short dated out of the money calls that would drive like gamma max up. But the leap interest increased when IV bottomed out a decent amount. I'm a few minutes behind. When you talk about credit spreads tightening, what does that mean exactly? Well, yields go up as people sell US treasuries, and selling US treasuries drives the dollar down. And so the inverse of that is yields going down, and the dollar going up. And so we're seeing the spread in credit there tighten. From a lending standpoint, that means that the amount of money to be made off of lending money at the uh, risk-free rate is declining, and that means financial conditions broadly are tightening. Could you discuss the JNJ play so far and the ideal way in which it would have played out with the benefit of hindsight, i.e., the entry at 175, the levels in which profit should have been taken, etc.? I mean, I guess we could talk about it a little bit, sure. I mean, I don't think it didn't play out ideally. I was very happy with the way the J&J K-View, like, the breakdown of the arbitrage play has played out. So yeah, I mean, short at the peak of like the 175, 38 resistance was obviously ideal, but shorts could have been taken in the lower range of that channel as well, and they still would have been profitable. Although IV didn't pick up on them on the contract significantly, they went very deep in the money. There was an opportunity to re-enter short positions right around here. I know some people did, some people didn't, and then that's continued to break down until now. Um, Obviously, the unwinding of these arbitrage plays is never, it's usually never perfectly symmetrical, especially ones as large as this, because there's a lot of risk in unwinding the position. But, generally speaking, mechanically, an arbitrage play, where they're long J&J and short K-view. hard to there. Um, Going into this, right? So this and this. Mechanically, you know, the unwinding of those would cause JNJ to go down as they pull back their long position, and KVU to go up as they pull back their short position. In this instance, you know, JNJ has gone down pretty significantly and still has room to go. We may even see it get back to like 155. But KVU's remained, you know, besides like some spikes, pretty static around like $22 to $23. The short position is still very much entrenched there. They may not need to get out until market conditions change or they're pressured in some way. I don't think there's any benefit to them trying to exit all at once. So we're not seeing them exit. And so in practice, you know, arbitrage plays don't always break down like that. You know, sometimes one asset will go down, the other will stagnate and go up at a later date. Which is, you know, a lot of, this is very similar to what we're seeing now. You know, sometimes both assets will continue to kind of trade sideways for a while, and the breakdowns are much slower. This was kind of, you know, I figured the JNJ play was a little bit too big for this slow outcome. This was a massive arb trade, billions of dollars. And then, you know, sometimes, you know, one asset will, like the short asset will rocket, but, you know, the long asset will just kind of stay flat. And so you really never know how they're going to back out of it. The best thing you can do is have exposure to both sides, because one of them is likely to profit greatly. And so I mean, given that the J&J options are up, you know, if you bought 170s and 175s and even 165s at any point during the time horizon for this play, you know, those options are up anywhere between 100 to 500%. And you know, the KVU options are, they can't be down any more than 100. And given that KVU was so heavily shorted, the options were extremely cheap to begin with. The biggest problem that I saw people make was they decided to play one side of the arbitrage play, and they missed out on Johnson and Johnson, which is, you know, ultimately the side that paid. Can you go over Tesla when you get a chance? Yeah, I'll hop on it in a second. All non-GAAP is unaudited, but all unaudited is isn't non-GAAP. Yeah. There's a little more padding in non-GAAP reporting for things that they're, you know, allowed, especially allowed to claim as revenue, which, you know, wouldn't be applicable in GAAP reporting. And that, you know, that's really important for a lot of tech companies because they have things like goodwill that are, you know, kind of hard to report effectively in like more standardized accounting practices, right? Could you discuss the J&J play so far? Okay. Seeking a review and how I play to improve going forward. Oh boy, a chance to like the stream. Thank you, Taco Squire Gordon. Could a month of theta warranted for a re-entry on J&J eyeing 150 as a PT? The play worked out great for me. Probably one of my best, but still did not hold my final contracts as ideally as I could. Okay, but that's, I mean, that's something you're going to have to learn over time, right? I haven't gone over Baba yet. Peeny Peeny Biggle Weenie. What's up, Doric? How you doing this morning, man? Anyway, so that's J&J. And so KView, you know, if you want to try to stay in it and capture the rest of the arbitrage play, it will probably unwind at some point. I would argue that it's already unwinding. It's just very fucking slow, right? It's not unwinding in the most ideal way. Um, let's go to the 1 hour where there's a little more history, but it is starting to, right? Like it's bottomed. It's starting to come up. It's gotten consistently higher lows over like 3-ish days, and volume starting to pick up. So it's likely, and believe me, I'm well aware most of my KView position is for September 15th and also shit. Um, but I do have some for October 20th that I rolled some stuff into to buy some more time. But October 20th calls are still dirt cheap. But it is starting to unwind on this side of the trade a little. It's just taking a lot more time, right? And so really the only answer there is to get more theta. If you have these like shitty September 15th positions and they're really burning a hole in your pocket, sell something against them. That's really all I can say. I mean, there's not a lot you can do there. But that's why you take both sides of the trade, because this side of the trade profited massively, and that way it offsets. It's almost like a straddle, right? Like it offsets the loss in this side of the trade by the gain on this side of the trade, which was significant. Tesla. So Tesla's been getting a lot of like good reports in the media, based on their increased sales due to their lower prices. Now, cutting margins in order to increase sales volume isn't a great path forward for the profitability of the company, and this is something that was largely realized in their last earnings and is yet being spun bullishly yet again, for this coming earnings, where it will also be a detriment to their forward valuations. Um, Interestingly enough, their volumes are not up enough to offset the cut in margin. Those back orders are $100 deposits, magnanimous. I swear to God, if you're gonna argue Tesla with me, do your fucking research first. It's not like people have put $60,000 deposits down on Cybertrucks that don't fucking exist yet. Now, I don't care if they're coming off the factory floor. Most of those orders are going to be fucking canceled because now nobody wants to finance them at 15%. 2 years ago, when they placed the fucking deposit and they were going to finance at 5 or 6%, it didn't seem like such a bad fucking deal. Anyway, Tesla this week failed to break out above the 260 resistance. More short calls came in going into the end of the week, and more puts piled up on Friday. I would wait for a breakdown at 243.50 to confirm an additional move to the downside. But we could easily see Tesla break down to like the 230, 220, or even 215 level over the next week or so. Yeah, just so you know, Magnanimous, when Carl says full port Tesla, he means puts. I heard on vacation September 15th, won't be able to trade until September 26th. Okay. I have September KView 30. I want to roll them to October. My only issue is not being able to manage it. That's a problem. I don't really have a solution for. You could buy shares, I guess, if if you want exposure but are unable to manage it. Do you understand cost of financing, Magnanimous? I'm not, dude. Uh, it's. I'm not gonna get into it with you. What was the other one? Somebody wanted to. Tesla. Oh, Baba. I have not gone over Baba, so I'm still both long and short Baba. My puts aren't doing as well as they were when we were trading in the lower range. And the bounce on Friday wasn't great, although it really hasn't bounced enough to confirm the upside here. And the fact that it was rejected so hard on Friday is probably pretty bad. But the Chinese government's continuing to roll out programs that are beneficial to Baba because, well, Baba's kind of part of every major economic sector in China. So almost any stimulus the Chinese government is going to offer up is going to positively affect Baba. I would probably just not fuck with it for now while they're, releasing midnight sweeping economic changes every other day. But since I'm already in it, I'm just going to continue to hold my calls and puts and see what happens. I'm in a pickle, man. I sold some $2 covered calls for November on Fubo. Why? I was waiting to cover downside risk, but I'm underwater now. So you sold in the money calls. So you started off underwater. I mean, you're just gonna get assigned. That's You could buy an out of the money call in ratio to hedge. So if you buy like a $3 call and the price moves up, then you can, you've only got a $1 gap. So say we run to 4-ish again, you'll make the difference back on the call, and then you can roll all that capital back into shares the next time the price drops. But other than that, there's not. I mean, sure you can roll them, but it's probably not worth it. Catching up on TikTok. Do you expect more data to refine the timing when bulls will run out of steam? I think most of the data up until the Fed meeting is in, besides CPI and PPI. So I think the economic conditions are kind of are gonna lie where they're at for now. This week's really light on data, or at least really impactful data is very light this week. I think we have ISM services, which is probably going to continue to be up, and that means more inflationary pressure. We're gonna have some productivity shit, and that's about it. Yeah, this week is pretty awful. Vehicle sales, I guess tomorrow. Factory orders, X transportation tomorrow is kind of significant. Those are gonna mostly affect the producer side. We have import export and Redbook, and then services PMI for S&P and ISM. I think Thursday, not much, just the labor costs and productivity. I don't think we're going to see the gains in productivity that they're forecasting. Um, Friday, we get, end of day Thursday, we get some Fed speeches. Friday, we get some Fed speeches. Then we have used car shit, I think aftermarket close, and we have wholesale inventories. So not anything big until next Wednesday, where we get CPI. CPI is going to be the next big one, and oil was up all of last month. Oil's moving up again. That's probably going to put pressure not only on CPI but PPI, which is going to follow that next Thursday. And then next Friday we have the Michigan preliminary for September. And that's about all that's coming up between now and the FOMC meeting on the 20th. Where it looks pretty likely that the Fed is going to move forward with their last rate increase. Catching up at 2x speed, do you expect more data to refine the timing when bulls will run out of steam and the market will dump from aside from an external event? So I mean, yeah, as long as the current currency conditions persist, the risk in the carry trade between the yen and the dollar is going to continue to expand, which me and Dork will get into here in a little bit. You know, credit spreads are continuing to tighten, financial conditions are getting worse. All of this kind of has a trickle effect. Obviously, a catalyst would move things along faster, but they're all sort of catalysts in their own right, and they're already very much in motion. You know, we're only 1.1% unemployment away from a recession, and given that the error rate for the unemployment surveys is about 0.3%, we may already be in one as of last week's report if there's a revision before the next one. So if they revise unemployment up on this last unemployment report, we're in a recession already. Ahead of the Fed's projection for end of year, beginning of 2024. You're traders. I'm an investor. I see the long term, it's there. After everyone bag holding Underwater, Bobby, and Jimmy for years now, I think people here would spot the difference. What's the long term? Increased competition across the sector? You can call yourself an investor, but you don't know anything about the function of the company, which makes me wonder if you've done any of the research necessary for your long-term investment. I don't think like Tesla's a bad company. I just think they're extremely overvalued. Any chance Charmazard can heavy lift us up into September OPEX? Probably not. It depends if we drop, I guess. If we drop and we start to get a lot of puts on the money, then sure. But otherwise September OPEX. If we stay at these levels into September OPEX or higher, that doesn't look very good. Not the ideal situation, but shares of KV seems like a decent idea. That or stay cash, because there's always another trade. Yeah, I mean you could always like do a buy right and sell the covered call at like your projected PT. And then, if it hits your PT, you sell and you make money. If it doesn't hit your PT, at least you made some money back. Thank you for your teaching. I successfully used a call debit spread to save a blown out condor last week. Nice, dude. Airbnb. So apparently Airbnb was added to the S&P 500 at the end of the day on Friday, which I didn't even realize it was up for inclusion. I couldn't, in retrospect, I still couldn't find any news that announced that it was being added. this Friday. But yeah, it's been added to the S&P. I'm not sure how long the overnight gains from it will persist. It did have some volume, but it wasn't extreme. It was like 200,000 volume. So a lot of this may mean revert before market open. If it doesn't, I'll just close my debit spreads and reposition a little higher. I'm here to learn the secrets of VWAP. It's not American competition. That's not relevant. So I want to buy SREF, but the fees? Do you dislike Eura? No, I have a little bit of Eura. SREF's fees are nominal in comparison to the price advantage, though. It has very strong exposure to spot, and additionally can is a catalyst for driving spot higher. Pretty big fan of SREF. I do have some URA, just not a lot. Sorry, I don't want to be annoying. So the November CCs are gone. However, since Jan 2 CCs have a lot of theta, it'd be rare for assignment with so much TVP left unless they traded a discount. I mean, the November CCs aren't even gone, right? But you're underwater on them. Like it sounds like you're gonna stay underwater on them unless you buy them back and resell them higher. I don't know why you sold in the money covered calls for November and Jan unless your expectation was to sell your shares at $2 plus the premium differential between that and the price it was trading at the time. I mean, that's very literally the risk you took when you sold in the money covered calls, right? You had an opportunity there if you sold them before we dropped under $1.90 to buy them back, but you didn't, or you sold them after we dropped under $1.90, which is not great. That's not a defensible thesis, Magnanimous. I don't care if you think they make compelling vehicles that people want. That has nothing to do with running a business. Given the inflationary and what's looking to be stagflationary environment, thoughts on gold miners? They've been trashed for decades and get milked hard. Think they could ever turn around? Yeah, gold, the ticker, they're not bad. They have pretty decent, slightly leveraged exposure to gold. Or, you can just go long like GLD or something like that. If currency scares are going to become an issue, then it's probably not bad to have a small hedge of gold, silver, and BTC. You don't need physical or anything like that unless you're a prepper, but they're not bad. They're not bad currency hedges. Also, thoughts on like zero DTE credit spreads 2 hours before close on SPX. I'm trying a new strat, so it doesn't work too badly if, and this is it's not that new a strat. JFresh has been doing it for like 2 months now. But you need to be in a decreasing volatility environment, not an increasing volatility environment. If you start trying to do it in an increasing volatility environment, you're going to get blown the fuck up. I see Tesla is a better bet, making compelling vehicles. Oh, okay, I already read that. When market correction? Well, we may have already begun the next leg of one as of last week. Taco Woo. Time out Tesla boy. I just ignore him mostly. I think I'm overly leveraged to the downside, so do something to rectify that. I was wanting to cover downside in the overall market through September and October. All indexes look like they have a downturn. Felt Fubo would follow. I'm going off of what I read in OASI. Uh, so you're probably not wrong. Then you shouldn't be worried about near-term price action, right? If you're simply trying to protect the value of your shares by selling in the money covered calls, which is what you'd be doing there, um, and preserve, that value of whatever your spread was at the time in $2, then fine, right? That's not a bad idea. I frequently do that on shares of companies that I own if I think that the markets, like the overall indexes, are going to move lower for a period of time. Um, and provided you have sufficient capital to buy them back at the end of that period of time, it's a very good way to protect your investments. But you seem to be worried about the near term price action. And if you're worried about the near term price action, or possibly the price staying higher than you initially projected, you should probably hedge that. Is there a point in Bitcoin, fundamentally, technically, or otherwise? And is there a play? Bitcoin seems pretty dumb to me. No, I think it's mostly worthless and hard to transact. So I'm not a fan of Bitcoin. I would never buy it at its current prices. But if it went down by about 50%, I would consider picking up some as a hedge. Gold and silver structurally are more important for banking needs internationally if there's a currency issue. So they will run. It won't be like Bitcoin will run and gold won't, right? If a currency issue were going to drive interest into one, it'll drive even more into the other. I still love you. Thank you, Magnanimous. Do some research on your investment, man. You'll identify a much better price to buy it at. You don't want to be the guy that bought it at 250 when it's worth 80. Sideways 8. Welcome to Cornishon. Thank you so much, man. Are we seeing the beginning of a nice commodity bull run, or do we see a pullback of the rest of the market first? Well, so energy's pushing commodities a little higher over the last week. We've seen broad commodity index futures move back up from their initial breakdown at the test of 108. Hopefully, energy will start driving higher now into higher diesel demand season and higher natural gas season. The tailwinds provided by continuous rise in energy will help to lift other commodities, and also uh, commodities will benefit greatly from China's attempts at economic stimulus. So I think commodities are due for a cycle. I think that everything's kind of in place for them to realize one. It may be slow. They generally don't move very fast unless something goes very wrong in another part of the economy. But it does look like that we're slowly building into broad commodity price improvement. Some of you already know that I've been quite long energy and commodities for about, like, in my more standardized portfolios for about, oh, almost 12 months now. So yeah, I've been continuing to accumulate those positions as they've been very cheap. Some of them still are pretty cheap. Primarily focused on uranium, copper, coal, nat gas, and oil. But I do have some carbon capture exposure, and I have some gold and silver exposure as well. Silver, I mean, you could think of it as a precious metal, but it's also an industrial metal, which is a little more. I actually like silver a little more than gold right now. I'm thinking about some exposure to aluminum, but I'm not sure yet. And then I really don't have any interest in like rare earth metals or anything like that right now. Like, I don't think there's any value in lithium. Um, I know that's one that everyone's really hung up on. Solar may have some value. Not yet, but I think there'll be a cycle for solar as well. Do you still like HCP in this environment? I don't know how insurance fares in a recession. I haven't looked at them in a while. HashiCorp's not really insurance. They're packaged software, kind of like Cloudflare or something like that. But they're back in my buy range. I actually sold out of all of my HashiCorp when it hit my PT back here before earnings, actually, which worked out well for me because their projections weren't super great. I do think it's a good company and it's well run. I don't mind buying at these prices, but I'd much prefer to buy under 25.50. Yep. Had a hedge, but doubted myself. Well, don't do that. Thoughts on GDXU, 3x levered, problematic, in a higher for longer environment. Gold miners, 3x leverage. I don't like carrying 3x leverage ETFs or ETNs. Probably not. I'd probably identify gold miners that are worth buying. I'd much prefer to identify gold miners worth buying versus buying a broad index of gold miners, especially a leveraged one. You could probably do like a dispersion trade on this. I don't know if there's a bear, like a similar bear ETF, but maybe you could like sell vol on the bear side to offset your volatility decay on the bull position. You could also just use like debit spreads. That can be an advantageous way to use these if you want to have like a longer term holding. But many of the same risks still apply. What about platinum? I'm not sure of the industrial applications. Is there palladium use for catalytic converters? Yeah, but both of those are highly recyclable, and the inventories of them are pretty decent. I already went over Baba. I grabbed a 95p to pair with my 90p. You should probably grab a C somewhere in there because China keeps changing their economic projections every other day. Look into recent Terraform licensing changes. If you're going to go long HashiCorp, can you just be more specific? Because it's something like very industry specific. I mean, you probably have a better grasp on it than I do. So out with it. Do you have any rough GME price targets around earnings and September OPEX based on highly shorted scenarios and stagnant liquidity? I mean, I'm just targeting Gamma Max at the peak, which is roughly around like 23.75 here. If it goes above Gamma Max, cool. I guess I have October 20 expiration 2025 spreads, and I have September 15th expiration something. I think 20, they're either 1922 or I might have 1922 and 2023. The reason I'm using debit spreads on GME is if it moves south, I'll take less of a hit and I can buy shorter dated contracts without having to worry about the loss in theta. No problem, David. All right, let me see. Got a little past my Q&A time here, but let me see what Dork and Jfresh are up to, because we have some fun shit to talk about.
Hey, Girk.
What's up, nerds?
Oh, nothing. Just trying to resist
Hold
my
on, I gotta
urge
turn you guys.
to
Why the fuck can't I
rant
hear you?
about Tesla for a half hour.
Am I muted?
No, we hear you.
Can you hear us?
Hello,
Hmm.
Oh, now,
Girk.
hold on. We hear you.
You can hear me. Well, that's nice.
Does puts cost same like shares, Girk?
Give me a
No.
second. I gotta get rid of this.
Testes, 1, 2, testes.
Devices.
Hey, Girk, don't respond to me if you have small testicles.
Got him.
He'll never even know how much he was just wrecked.
Dude. Oh my. Tell him.
Nah, he knows.
That's true. I wish I took notes this morning, but I woke up at like an hour
Right,
before.
let me just rejoin.
Like an hour before
Nope.
getting on here.
Still
Can you
no
hear us now,
fucking
Girk?
audio. My headphones just broken?
Should I start pumping German techno through Discord?
I don't know. We don't want to get when he switches it on. We don't.
Hey,
want
there we go. I got it.
All right. Oh
Fixed it.
shoot! If it's just his headphones, then that means everybody else could have heard us.
Yeah, yeah. Everyone can hear you guys.
Oh no! So awkward. All right. Well.
All right, Dork, consider yourself timed out for however long. Carl's adding to the core fund again.
Damn it, Carl.
How you guys doing?
I'm doing all right.
Yeah, pretty good. Hanging out.
All right,
Just
Dork.
crunching ball.
Do we want to talk about correlation first? Do we want to talk about Dixie and spreads? Do we want to talk about me and Dork attempting to quantify the value of a forward swap on USD JPY?
That's a good question. I mean, it's all very interesting. I think that the value of the forward swap is probably a good thing to sort of discuss. Um, because, you know, you could use that in sort of kind of like a stock. You can like imagine when these were, and this came from a discussion where I was bitching and moaning about like we should, you know, simulate the returns on a forward swap to see, you know, how fucked somebody is if they open one of these at a specific time. And then Girk was like, well, we're already kind of doing that, and then we talked about it a bunch. So yeah, that chart, it was that one where it's like that one single line. That was super interesting because it kind of showed how it kind of showed how it's possible for you to have like a dollar shortage when a bunch of money is pumped into the economy because it just goes somewhere else, you know, that's not the economy. Um, and yeah. So this chart right here, right? It kind of, that's 2021. So yeah, this chart is it's pretty cool, and yeah, you
You're
see
welcome.
yeah, this is pretty cool because like to me, you could sort of look at this and identify sort of how much spreads have been blown out and how it's affected the exchange rate between the two, and also how much the exchange rate has an effect on those spreads as well, like the converse condition. I didn't spend a bunch of time last night thinking about it because I was busy trying not to think about the destruction of the U.S. dollar.
Ah.
Well, so maybe explain it to me if I don't understand it. I don't know if anybody else does. What is this measuring between the USD and JPY?
So it's almost like a weighted valuation of the exchange rate based on the credit spread at equal maturity.
So it's the US 10 and Japanese 10-year bond spread times the USD JPY, like the currency cost or the currency spread.
Okay. Yeah. Okay. Yeah.
So you're kind of simulating the forward returns of the currency swap.
Yeah. Yeah. The I think so. Here's a question I have, and I don't know if you guys have an answer to it, but is this widening spread? Does this have anything to do with the reason that a lot of the spreads for credit in the US are so low?
Yes.
Can you explain that?
So, yeah, there's less demand for credit in the US because the spread on it is insufficient to make money. And this is what we talk about when we're talking about credit spreads tightening and how they affect financial conditions because, because they want to lend on the back half of the curve, right? And if there's not enough of a spread there, there's no profitability to lending long term, right? And so by turning to Japan, they're able to open up a much wider spread where there's significantly more profitability lending on the far end of the curve, right?
Here's my, so I guess I want to understand why it's so cheap for companies to still get credit relative to the US bond.
I mean, is it? It should be about equal. They should be getting credit at like 6% right now, although that's getting tighter. Those rates are starting to move up because, well, demand for them is dropping first of all, but also the Fed keeps raising the effective federal funds rate.
Yeah, I just, it seems crazy. It seems like, especially, less than stellar debt should be priced at much higher rates than they are now.
Well, yeah, I mean, but that's part of the inversion of the yield curve, right? And so as that normalizes, yeah, well, the spread between like corporate bond and US debt will tighten, right?
Yeah.
And that's sort of that's what this is like. The inverted yield curve sort of necessitates this kind of a credit structure, in order to maintain some semblance of a good risk-free rate. Uh, and and in a way, it sort of puts pressure on the yield curve itself too, as it unwinds, right? And as the yield curve flattens out, and we're looking at a bear steepener, I think is what it's called, um, on the yield curve. As that sort of plays out, you'll see this sort of a trade begin to unwind, and that's really what puts stress on the liquidity of the Treasury market because the attraction to U.S. debt will increase as risk reduces, and at the same time, you have this sort of a carry trade happening, primarily on USD JPY that's trying to unwind in the process, right? And especially if JPOW cuts and the spread gets cut off, right? Or if just real yields um, continue to loosen, it'll put pressure on the yield curve, and in doing so, reduce access to liquidity for people who need it. And it's the connection between the equity market and the credit market is somewhat nebulous. But when you think about portfolio margin and how certain sort of positions, be them like performance swaps, things like that, how they're rebalanced and maintained. A lot of it relies on taking out debt as part of your position, um, and then and calculations of the interest rate on that, like ultra short term debt, that kind of stuff. So that's sort of like the and I'm staying at a high level. That's sort of how the credit market and the equity market are linked, is through these ultra short term loans from prime lenders in order to replicate specific types of positions and performance. So yeah, and that's kind of why when you see the yield curve, correct back into a normal sort of state, you'll see equities suffer as a result, because how people hedge and replicate positions, all those calculations change, and pretty drastically. So your ability to and your ability to sort of get access to the credit you want at the rates that you're calculating start to become more unpredictable, and your risk at the margin expands. So people will their risk appetite will really drop pretty significantly to enter into new positions, because they won't be able to forecast as easily how those positions will, like the payoff on those positions, the cost of hedging those positions. The Monte Carlo is a lot more wide in that regard.
Yeah, sure. I mean, more uncertainty will.
And you can see here, like, it's really obvious, like, from where the Fed starts raising rates through our almost market crash in October, right? We see a 364% increase, right? And then around the time of the December YCC change, we start to see the de-risking behavior in the carry trade. Then more so in the bank failures, and then now with Japan's most recent YCC change and forward projection of moving to a more standardized monetary policy, we're starting to see, we're probably going to see more risk off behavior. I would say that some of the current move upward in equity prices is largely due to that self same risk off behavior, right? And once this trade starts to actually collapse, if you look historically, it's very, very bad for equities, right? If you look at, this was the data only goes back to like 05 here, but that's more than sufficient to see where actually I think it's like early 06. It's more than sufficient to see where the carry trade peaked in 07. And that began de-risking all the way into the crash in 08. And then we see the carry trade picked up a little bit as interest rates normalized over the next couple of years, and then dropped back again in 2012 when we had kind of the peak of the bear market. Yeah, it was like the double dip recession.
Yeah.
And then we see federal interest rates start to normalize again, all the way up into some of the rate scares through 2017, 2018. And then we start to see the carry trade break down from 2018's peak, right, into the COVID crash, where US rates normalized very rapidly, or dropped very rapidly. And so obviously the back end of this is far more accelerated because they pulled US rates back to zero and collapsed the trade. But then, on the opposite side of that, we start to see where the Fed begins to raise rates again. And now and because the Fed raised so quickly, they've leaned on the carry trade very, very hard, right? Historically harder than they ever have. I mean, the peak here in '07 was like 400%, and in 2022 it was 587%. Right now we're at about 518.95957. It just changed. So the de-risking of this is enormous. And they've already sort of begun to de-risk it, right? This is on the weekly.
Yeah,
And so one would argue that, the COVID crash was going to happen regardless of COVID, um, because
yeah.
because of the interest rate changes. COVID just accelerated it.
Well, I mean, it's important to go over too, like in 2019, we were seeing financial conditions start to deteriorate. There was like the taper tantrums, what they called it, and we had several banks get, some large emergency like loans for liquidity.
Mm-hmm.
Back in 2019, like some GSIBs were really, feeling pretty stressed out, and the COVID crash, turned out to be a very convenient, way for. I mean, it's not like, I'm not going to go full tinfoil on the pandemic. That's a fucking pandemic, but it turned out to be a really convenient way to just, reset the credit market at the same time, that the economy is going to get shut down, right? So uh, it worked out, but on the back end of that, now we have, so much money in the form of low interest has flowed into the monetary system that the only way really to continue to get the kind of growth you got in 2021 and I in a way 2020 um, is to leverage any sort of spread and yield that you can with all of this money that you have, right? That's not being you know pumped into goods, services, home loans, etc. You have to
Mm-hmm.
do something with it to get some yield on it, otherwise it's going to stagnate. And when that growth in money stagnates, that's when you have like on these super low risk, comparatively speaking to like a home loan, these super low risk yields. When those yields stop returning, your appetite for risk in the higher risk credit markets goes down. It starts with the home loans and the credit cards and those things, but that eventually bleeds over into like corporate debt. And we're already seeing most banks at this point, a large majority of them have been tightening credit standards for small and mid-sized firms for the past year now.
Yeah,
Uh,
adjustable rate corporate revolving lines of credit have skyrocketed, and so usage of those lines of credit has slumped significantly over the last 6 months, which is probably, from small and mid cap companies, is probably the first really big sign of a tightening credit environment. The corporations, being unwilling to utilize those revolving credit facilities for growth, mean that their growth is, the lack of access to that capital means that their growth is going to stagnate.
and even if they have access to the capital, the problem is the cost of capital is so high that if anything, their margins are going to contract on the growth they do get.
Yeah.
Oh, by the way, Girk, I think you got a Ko-Fi.
Yeah. I think it was it from you? Did you want me to time out Carl for $6?
Yeah, I
Because,
just
yeah,
put him up.
okay, because Carl's timed out.
Good. Yeah,
Nice.
Yeah.
I'm entering into a bidding war with him, but I'm not going to tell him my max
Well,
price.
he hadn't paid anything yet, so you just
Ah,
automatically, yeah, you got first.
You
there we
just
go.
priced out like his first 10 Ko-Fis.
Yeah, well, now he's timed, so he's going to
So
have to Ko-Fi.
so wait, JFresh, are you on the same page now?
No, I'm not going to give you money.
But no, I'm not talking about you bidding for Carl's and the
Oh,
only
okay.
thing I could ever
Yeah.
see
No,
you ko-fiing me for is moderator. But I meant about the carry trade and the tightening credit conditions.
I will. I just want to be clear. I will never ko-fi you to become moderator. You'll know when the time is right, and it will just happen, and it'll be glorious. But
That's
yeah,
true.
no, I think I understand. And now my next question would be, if you look at this chart, it lends the some idea to perhaps the market could reach new highs off of this carry trade, because where's all this money going to go,
Well,
Yeah.
as the de-risking process continues, eventually you're probably going to see the peak of equities if we haven't already seen the peak of equities. Remember that the risk in the trade is increasing exponentially, right? Because inflationary things like oil or like energy costs are rising, and these are all of these things are putting more and more pressure on Japan to move to a more sustainable monetary policy than their current one, right? And Japan's currently experiencing inflation for the first time in like 30 years, but now they have too much inflation, right? And they need to moderate that.
Yeah, and I
Um,
know you keep saying that they kick the can and then change their mind a few days later, but they just kick the can again, right?
yeah,
It's not like
they're always doing this, but remember that their Ministry of Finances, which is like kind of like their treasury, if you want to relate the two. But their Ministry of Finance isn't. They're staying away from uh, control of yen pricing until like 150 supposedly. But the BOJ is actively participating in buying in the bond market in order to stabilize the yen already to the tune of like 1.5 trillion yen, right? So you already have them attempting some stabilization efforts. The stabilization efforts ramp up dramatically um if the yen hits 150, because then the Ministry of Finance is going to start actively shorting the dollar to support the yen on the open exchange, right? And that means selling U.S. Treasuries, likely treasuries with fairly significant duration, in order to effectively short the dollar and long the yen, right?
well, hasn't China been selling treasuries lately? I mean, this
China's
week,
China's been bleeding off U.S. Treasuries for some time now, but actually that chart's a little deceptive because recently as the yuan dropped, they started to buy back some U.S. Treasuries, because their currency is not in the best position. So their central bank is trying to keep their currency at about 7.3, I believe, is their target. So under that, they've been actively buying, and that's part of what supported our recent equity run, is that China's been buying U.S. Treasuries pretty heavily. We saw that in the spreads recently, right? Because the more treasuries they hold, the closer they can bring the value of their currency to the dollar.
yeah,
Yeah, they don't want that spread getting too wide. But at the same time, they don't have a lot of money without generating tons more debt to keep that process up for very long. So for a few days there, they were very strong buyers of U.S. Treasuries, but that's kind of falling off. Like it already started to fall off into the end of the week.
yeah. Okay, so you
Um,
think that most of that strange bond behavior was China and not
I think it's
the
China, but it's also supported by the banking U.S. banking interests as well, right?
Sure. I guess I
Yeah.
just see it as like a zero sum game, right? I mean, if everybody's buying everything and all these things are going up, what's going down?
Well,
So when you talk about when you said where are these dollars going to go, just to jump back a little bit, it's when we talk about the carry trade, it's less about actual dollars and more about dollar collateral,
yeah.
right? So it's not like we're actually, doesn't really have much to do with, like, it has something to do with checking accounts, because you're getting all these swaps that have specific payoffs, but what the real value in it is that you're able to collateralize your money while it yields, right? And then take that collateral and apply it to things like equities, treasuries, corporate debt.
So expanding margins, but don't we measure that? I didn't think margins were expanding that much.
Well, this is how you keep them expanding, right? That's more
Try.
so like,
Yeah.
yeah, it's
The
in
finance the
terms.
finance sector would benefit from this far more than like tech, which would be like a tertiary beneficiary, right?
Yeah, this is and yeah, these margins are, yeah, it's mostly, it's more so, margins, especially like with this stuff we're talking about, it's almost like a spread in itself. Um,
So you can
where
kind of like draw like a flow chart for this, right? Like if you look at
Oh,
like the
margin is expanding. Never mind.
DTCC haircuts, right, to these like duration risk securities, right? And then the banks are holding all of these and they need to find somewhere to put them where they can collateralize them, and that's where, they moved to Bank of Japan, right? And then, they collateralize these securities with the Bank of Japan, so increasing the Bank of Japan's holdings of long duration US securities. Then they leverage those up, margin, right? And then they take that money through like US on like subsidiaries, and they start lending it, like that leveraged capital. They start lending in the US at, like 5 to 8% interest, right? And they've got, like 0.5% interest here, right? And so they're capitalizing on this spread.
and this is sort of why, interest rates for the average consumer for things like home loans, like the mortgage rate, this is sort of why mortgage rates are able to be,
This is
held
why, yeah,
at
this is why
low as they
mortgage
are.
rates aren't like 13%.
Yeah, this is pretty much wise, because this spread is wide enough that they can get the margin they need to be able to offer them at these pretty dang competitive rates, considering how illiquid the debt market is at this point.
But here's the caveat to doing this, right? As the Fed continues, and you can, this will kind of explain to everybody why all the banks use all their media arms to try to push back, and they try to use equity prices and everything they can to push back against the Fed, is because as the Fed continues to raise rates, right? Then they're starting to take on more and more and more risk by keeping rates competitive, and so they're forced to push their lending rates higher and higher. And we've seen that with the mortgage rate, especially over the last like 2 months. We've seen the mortgage rate jump almost like 1% from like 6.8. Now we're in the mid sevens, right? And we're quickly hurtling towards 8. And what this starts to do is this starts to affect the asset bubble, right? um, because as those rates continue to increase slowly over time, you're going to get less and less demand for homes, right? And you're going to start to see broader sell-offs in like MBS securities and CMBS securities, which is going to drop the value of those securities, which then affects the margin that they have leveraged at the BOJ, right? And then they have to start to unwind all of this the other way. And when they start to do that, that's when everything kind of collapses. Well, at least that's when everything started to collapse in 08. Started to collapse in 2018, 2019 for similar reasons as well, right? So,
All right.
you can pump that asset bubble as hard as you can to run away from the problem, but it's the turtle and the hare, right? Like this problem doesn't stop getting worse, but there's only so much you can pump the asset bubble
I don't
before
know.
you
Housing
exhaust it.
prices are just taking a nap right now.
Well, they're
It's 'cause they're
down a
liquid.
bit. They're starting to fall.
Yeah, I mean,
Yeah, they're starting to fall
housing's
in some
always
markets,
And
but there's a lot worse.
liquidity will increase, because while there isn't liquidity in the current range, if those prices drop and equity value is lost, the liquidity is going to expand very, very rapidly, right? We know this because of Gherkin's law.
Yeah, this is and housing is something that, like, in terms of home prices, and like why you have to be such a huge bear to think home prices are going to go down. You think about yourself in your house. If you own a house, it's like you're, even if like you may be stuck right now, right? And if you have a low interest rate, you're definitely stuck. But
Oh
like,
yeah.
people aren't going to sell their homes until they literally have to. Like, there's no other option for them. And currently, there's options available to people that don't involve selling their homes, and that's why the market's just crazy illiquid. No one wants to buy, no one wants to sell, and so we're just stuck here with no participants besides investors, and even they have really kind of fallen off a cliff over the past 6 to 8 months. So it's I mean, it's an interesting point, but like, the bottom in housing didn't happen in the '08 crash, right? It
No,
happened
no,
well
no.
after. It happened like 2010, 2011. So, they just started declining and just steadily kept going down over the time that people were continuing to not have jobs. And,
I think that'll be, and I've had this argument with like Surface Smurf a bunch on stream, but I think that'll be faster this time around,
it could
as it's
be.
realized, because pricing pricing in the housing market is now more efficient than it was in 2008 through 2012, right? So, what took 4 years to be realized broadly across several regions in the U.S. back in '08 and 2012, now because of Zillow and Redfin and these more more efficient pricing models, housing pricing is likely to move faster, and then because it's illiquid, that means the housing market pricing is going to become more volatile, right? Which creates
Yeah,
fear.
I
Yeah, I just
agree.
looked at Zillow at my own home, and in the past month, it's gone down by $65. So
Mm.
Damn,
I'm
dude,
feeling it.
you're underwater,
My margins just got crushed.
bro.
You say that now, but in 3 years it may be like 60% instead of $60, and that's going to be where it hurts, not at $65. But I mean,
Yeah, I'm making
you're
a
well
joke.
capitalized, and I don't. Yeah, I know. But and then unemployment also has a significant effect on the realization of liquidity in that market, right? And we do know that the Fed has already probably done more than enough for us to see 5 or 6% unemployment, and they're continuing to push, right? They're going to continue to push, and they're going to continue to hold because they need to destroy the money supply. Um, Not only do they need to reduce the volatility of the money supply, they need to contract the broad supply, right? Otherwise, we're long term fucked. So I think the Fed's aware of that. I don't think they're going about reducing the money supply in the best way possible, but they're going about reducing the money supply in a way that will destroy the least amount of wealth up front, um, which benefits them personally because they keep the revolving door open. If JPOW just started dumping securities on JPM until they failed, he wouldn't be very popular in the banking industry moving forward. He probably wouldn't get 150 grand a couple times a year to do speeches at economic councils, right? And so I
It's
What
less
wouldn't.
about
is what?
PayPal, more about
In his
people like
position,
Fubo
would
cutting
any of
party.
us give that up?
I
Yeah.
don't know, but at some point, it's how much does it really matter? I mean, if you're gonna retire with tens of millions, I don't know how much money he has, but I assume he has plenty of
I
money.
assume he spends all $180,000 of his salary a year on hookers and blow, and then probably uses the government stipend to pay for everything else.
So, and also, like, it's
Maybe.
less about JPOW for me than it is about the other members of the Fed who, you know, like a Bostic, Kashkari, those folks who are thinking more along the lines of the revolving door, right?
Yeah.
Than say JPOW.
Yeah,
Yeah, all the
JPow's already
bounce.
kind of achieved the top, but he's only one of the votes, and he directs and guides the meetings. But I mean, he's not. He is just one vote, right? And ultimately, they do need a majority to make any kind of changes.
I guess, and this comes back to the discussion that we had, you know, like in, I guess back in December or January, about like the, you know, control theory and the ability of them to actually orchestrate any sort of soft landing when your lag between your inputs and outputs are so.
I mean, I think they've given the banking system as much time as they can buy them, right? In order to offset the depositor flight. But the depositor flight's continuing, right? Like the deposits they haven't stopped going down. Money's still flowing into money markets. So the conditions are only getting worse for the banks. All they really got out of March was some more time. But you know, credit's tightening across the board and lending's becoming nigh impossible.
Ooh, I have a
And
chart in my chart.
without this spread to facilitate continued lending in the U.S. would dry up probably almost instantaneously. There's no other liquid market as advantageous as Japan right now. I mean, they can't go to the EU. They can't go. I mean,
What, the Turkey?
yeah. I mean, Turkey's they're not the economy's not big enough to support it, right? Like their central
Yeah.
bank can't just pick up a few trillion in, you know, used up U.S. securities. So you know, Germany, Japan, those would be like the only China, but China's got their own problems, right? So there's really no other entity out there that can support the carry trade, and so as inflationary pressures increase in Japan, that carry trade is going to collapse and there's nowhere else to go, and then the credit markets are gonna take a very very big hit if not collapse, right? I
Okay.
mean,
But I guess what I'm getting at is why would JPOW want to increase rates one more time, right? I mean, if you're starting to see the delayed effect, I get that from a statistical perspective, the number that we have and the uncertainty around it, it's not even really clear how much of the bump in unemployment we actually have. But I think there's enough indicators that are suggesting that if things aren't slowing, like reversing, they've slowed down significantly. Their growth has slowed, but I don't know if it's slowed enough yet. That being said, I mean, if the Fed is recognizing that their effect is delayed by up to 18, 20 months, and we're already seeing something turn around, why wouldn't they stop? You could argue that more likely than not, they've probably already gone too far.
I would agree that they already have probably gone too far if you weigh out the next 2 years, but they cannot risk inflation reigniting, so they'll just keep raising until something breaks. And
Well, yeah.
even
So
once it breaks, they'll probably hold the rate steady for some amount of time in order to facilitate the destruction of the money supply.
and you know, right now real rates are just barely on the cusp of restrictive, and
And
not only
they're
that,
only restrictive because inflation is slightly down. If
yeah.
inflation moves back up, they become not restrictive at all again, right? So that I think that's why JPAT, like, he keeps just going like the fucking Energizer Bunny, and just keep hitting them with these 0.25, 0.25, 0.25, 0.25, because he's trying to create the slowest contraction possible, but he cannot let up on the pressure.
Yeah.
Yeah, so Girk, I have a chart when we're talking about deposit outflow as well. Like,
Oh, okay. Where is
that
it?
Fred chart I posted
Got
kind of
it.
explains why we're continuing to see deposit flight.
Yep.
It's just it's the PCE compared to personal income. Um, And, it
Yeah.
shows that we're, that the idea that wages are outpacing inflation is sort of not necessarily so easily asserted, right? There's
Yeah.
data that points the other way. And this is two consecutive data points of a widening spread between personal income and personal consumption expenditure growth.
This is
Uh,
also something moderately unique to American consumers. And part of the reason for this, and you can look at this same infographic a bunch of different ways, right? You can look at like personal savings.
yeah,
Right. You could look at like bank deposits or yeah, bank deposits held. You can look at deposits held at the Federal Reserve and see that those have completely stagnated.
yeah. And so,
So,
like, yeah,
but so I just wanted to say, yeah. So like, this is because American consumers aren't going to affect their own austerity measures, right? They're going to continue to buy shit if the price goes up because we're a consumer based society. And somewhere like Europe, if you look at this same chart, it won't be as extreme because more Europeans tend to spend the majority of their income on just basic cost of living. They don't try to live above their means. And the reason our core is higher is because we do. We like to buy shit that we don't need that's expensive right now on credit.
I
but
want it all and I want it now.
But yeah, you can go ahead. Sorry, I just wanted to add that into it.
No, that's pretty much, that boils it down pretty nicely. Um, and this whole idea that the market isn't the economy, right? It's kind of right, but this whole talk of the carry trade and how that affects, it affects the stock market and the real economy in very similar ways. The stock market, though, because it's so closely linked to the monetary system, is going to react much faster. If Japan pegged to the dollar, right, then you would see dollar collateral just tank, right? And that's why you'd see the stock market crash. Right. But at the same time, the knock-on effects, right? And this is like the real contagion of this carry trade is that you'd see the stock market crash just because like you just have a collateral crisis. And that would be that, and it would flatten out and bounce. But over time, the real effects on the economy are gonna just there's gonna be like this tsunami of margin collapse in,
Yeah, I mean,
in
I've always hated that phrase that the market is not the economy, because the market is a very important part of the economy, right? I mean, you
Yeah.
can't just say that they're completely disconnected and there's no way to resolve that disconnection, right? They are intimately linked. They're just not rigidly linked, right? But
I
so
mean,
it always makes me annoyed.
I've said this a
Yeah, it
bunch.
could just be crazy. It's not irrational. There's just a rationality buried down deep that you're not aware of, that somebody else is exploiting.
Yes, I agree with that. And a lot of that can be summed up by what Graham said famously, that I've repeated 100 times, is that in the short term the market is a voting machine, and in the long term it is a weighing machine. And historically that statement has always proven true. That eventually the market can no longer ignore economic conditions because economic conditions directly affect the models and pricing used to determine valuations in the market.
And the amount of money available to dump into the market.
Yep.
yeah, well, yeah, and it's kind of funny, but in terms of whether that's the tail wagging the dog or not is a whole other discussion you can have, right? Like, do instantaneous economic conditions have more of an effect on the market than we realize as well, right?
I mean, they can, and we know this, right? Like, there's I don't think there's any questioning that like certain larger economic shifts that happen suddenly have an extremely real effect on equity pricing immediately, right? Like there are catalyzing conditions which cannot be ignored. I mean, we saw that most recently with the YCC, right? Like Japan shifted up their curve control policy by zero point 0.5 basis points, which is relatively nothing, but in the terms of the carry trade, it's 100% change, right? And we saw the market immediately take like a 500 bps dive over the following 5 weeks, and and without really any other economic news coming in. So
You forgot and then proceeded to recover in 2 days.
well, it didn't recover all of it, and its recovery looks weak as well. But
Yeah, I agree.
I'm not going to get too deep into that. But yeah, I don't think the attempt at a recovery has been very successful, and people do not like higher unemployment. Broadly, the masses that have supported the bull run up until this point, tentatively, but have still supported it, are now scared. They bought 2.5% higher, and they're still 2.5% lower. So it's actually
it's a
closer
long way
to
down.
yeah, it's closer to 300
But I mean,
bps, and yeah, right now it looks like there's much more room to the downside than there is to the upside, and we see that in the lack of liquidity that bulls are able to find in the upper ranges of SPX over this last week, despite having momentum on their side. They were unable to achieve even gamma neutral and get the market makers on board to support price action. So I wouldn't say that the current pump looks very strong. I've kind of had
yeah.
that mentality about it ever since it started, but we will see where it goes. I mean, obviously, less data can be beneficial to that, but over time, these conditions aren't improving, and because they're not improving, there's going to be fewer and fewer people willing to step in and hold the bag.
Well, this pump was it wasn't even really like a Mag 7 supported pump. It was more of like a Mag 3 or 2 supported pump. It was
Well,
basically
yeah,
just
I mean,
Apple and Nvidia.
even
And
on that front, like we saw long-term holders in Apple and Nvidia continue to crush the incoming vol from the pump by selling short calls on their holdings, right? And so now you've got like they're trying to affect a dispersion trade, but you have vol crushing on both sides of the trade, right? Like you're crushing vol on the indexes and trying to pump it into the underlying like heavily weighted securities, but then all the long holders of those securities are selling that vol right back. And so you're not
yeah,
you're not getting that momentum that you need to carry the indexes higher.
yeah, and even if they could, I don't know what kind of. They just don't really seem to have all that much room left, because they've already pumped the Mag 7 up back to where we were when we were 60, 70 points higher on the index, which is also where we were, back in Jan of 2022 before everything started dropping. So, and a lot of this is on. I think for the Mag, I haven't looked at just the Mag 7. What's the change in revenue from that point to now for the Mag 7? Because like Apple's gone down, which is a big piece of it, but others have gone up. Microsoft has had good.
We could take a look at the S&P earnings yield. Give me a second.
I know the earnings yield in general, I think, has gone down. Yeah, I guess I
Yeah.
could look it up too. It'd be nice. It'd be nice to break it out just for the Mag 7, but yeah, I understand why that's. Hold on, let's see. In 2022, well, let's say 2021 quarter 4.
Yeah, so I mean, over this last quarter, earnings yield has dropped from March through July. Earnings yields have dropped from 4.73 to our current 3.88.
Yeah. So
GDP is also down. And remember that a large part of the fund flow into S&P that stabilizes and supports these movements come from mutual funds and pensions. And I think something that I've thought about this a lot recently, and I think a large part of what drives dumb money perspective on the money, or broader retail perspective of I'm going to be a bull, I'm going to be a bear, is the fact that they conflate price with conditions. And those two things are very separate. The market can be in a very, very, very bad economic conditions, but the price can be up. And that doesn't mean that things are bullish. In fact, the further the price moves away from the conditions, the more bearish things become, right? And
yeah,
that's something that we see broadly in almost every indicator, is that, financial conditions are in disagreement with equity prices. And eventually those two things will normalize, because mutual funds without the promise of forward returns will not continue to push their capital into equities, because they have very strict risk requirements that they have to abide by. The same is true for pensions. And once the earnings projection curve starts to decline into the future, you start to lose those net buyers that had followed the initial surge of positive news upwards. And without them there to sustain liquidity at higher prices, those higher prices become unsustainable.
yeah, yeah. I mean, the question is what's gonna turn things around, right? And perhaps quarter three is the thing to start doing. It could be because nobody's really projecting ridiculous returns until quarter four of 2023, which would put us somewhere into the beginning of
Well, are they still
2024.
projecting those now with the decline in GDP?
It looks like the current consensus for quarter three is a 0.1% growth,
So they're assuming that inflation's going to move higher.
and then quarter four it's down from like 11 to like 9.5.
It's ridiculous.
But all of quarter four, or all of 2024, it's predicting double digit growth each quarter.
Oh. Yeah, well, that's not happening.
Yeah. Everyone's the market is trying so hard to just fucking price in, growth wherever it's like slightly reasonable to do so, right? And
Yeah.
so far, at the same time though, a lot of projections put the recession happening in the next, 6 months, right? So there's a
And
huge disagreement.
I would say that we're probably, if conditions don't change dramatically now, but we're probably in a recession by the next unemployment report. If they don't just revise this one in 3 weeks higher. I mean, we're 0.1 away now from the somber recession.
Yeah, well, I mean, the thing is there's always going to be a debate about whether or not we're currently in a recession, and then later on, the economic whatever council of wizards says,
Yeah,
yeah,
they'll
that
be
was
like, "Oh yeah, we've been in a recession since 2020. It just never, it never let up." um,
right. Yeah, something like that.
yeah, they like to do that years after the fact, but I mean, I would say that it's going to be hard to ignore the fact that we're in a recession with an unemployment above 4%.
Yeah, and the further up unemployment gets to, like, there's a lot of knock-on effects to people losing their jobs,
Mm-hmm.
you know. So it's I mean, it's one of those things where there's momentum, right? Like economic momentum is a thing. Like if unemployment starts going up, it's not like you can't really just like cap that unless the Fed does something extreme or the government does something extreme, whether it's fiscal or monetary stimulus. It's what you need to like
Even
stop
then,
that.
historically, stimulus doesn't reverse unemployment quickly.
No, yeah,
Like that's
there's like,
extremely lagging. That's like 18 to 24 months
and
to
that's where like you think about like S&P momentum, like which it has a ton of momentum, or treasury momentum. That's one of those things too. Like the momentum of the economy is an entirely different sort of thing, because now we're talking like lives, right? And changes in the tide, right? It's so big and nebulous that you can't just like pinpoint something to make it get better like you can in the bond market or in equities, right? Where you can you can pinpoint a way to make the S&P bounce, right? You can, all right, we can go and sell all this delta, down below SPX, sell the short delta below SPX and make it bounce, right? But you can't go to the economy and say, well, we're just gonna short vol on unemployment, right? It's not. It's entirely different, and once the trend starts to evolve against you, that's it's not it's gonna, and it's gonna accelerate. It's gonna be self-accelerating too, as the economy, like growth is not necessarily the same way because it's capped by the amount of money available, but and inflation, but deterioration in the economy is the danger in it is that it is so self-propagating once it starts. Like if unemployment ticks up like to like 6 or 7%, it's gonna go higher.
Yeah.
Like just by nature of the fact that our economy is going to contract so severely that there's no way to avoid losing a bunch of jobs, and the whole economy just normalizing,
I
right?
mean, once reducing labor costs is incentivized in small business, especially because they're usually the first to start committing to larger layoffs, right? Because they don't have to worry about the PR and shit. They just need to protect their cash flows. And yeah, small business owners will take on that additional labor themselves. But once that cycle starts to propagate upward, and medium-sized businesses, private businesses, of medium and even large sizes start to be incentivized more and more to reduce labor costs. Once that spread starts, it doesn't really stop until the potential for future growth reveals itself, and increased labor costs become beneficial again. So
Right.
that almost
AI.
historically that
Oh,
cycle
fuck
has to
off,
play
Dan.
out. That's historically that cycle has to fully play out every time. And given that we haven't even really started that cycle and we're already at 4% unemployment, I don't think it's ridiculous to think that we'd hit 6, 7, maybe even 8% unemployment into 20 end of 2024 or 2025.
No, and once again, if we hit those numbers, that's it's
You're
hard to
talking you're
stop
talking about
unemployment.
defaults in credit markets rivaling '08 or exceeding.
Yeah, and
And
margin
on
contract.
on and because of the housing price differential, right? Houses are like 300% more expensive than they were in '08. The economic fallout notionally is going to be 3 to 5 times the size. So even if the fallout were significantly less than '08 broadly, the notional fallout is massively increased because people aren't defaulting on 60 and $100,000 homes anymore. They're defaulting on $500,000 homes all across the US.
And not only that, but the revenue streams of most of these companies is also massively inflated. So the notional fallout in money in cash flow is going to be enormous as well.
Yep. Leverage everything up, and ironically all the effects are multiplicative.
Who would have
Yeah.
thunk it, man? It's such
So
a crazy concept.
allow me to attempt to maybe get a little philosophical here. Uh, we're always talking about sort of the next quarter, next few years, but there's a lot of things that make this feel like this is sort of the end of an era. Um, so, like particularly the end of cheap money, aka cheap labor, right? So
Yeah.
as China has sort of closed the gap on cheap labor, and we tried to go to India and other places. I mean, labor is being very stubborn against the margins that we've enjoyed, and I think that drove a lot of our ZERP, momentum. Right, we were able to drop interest rates so low because stuff was getting so much cheaper than the labor costs in the U.S. But obviously that's shifting, right? I mean, we're getting a lot of strikes all at once from a lot of big players asking for higher wages and sticking to their guns and getting a lot of what some of them are getting a lot of what they've asked for. Um, that's going to put wage growth pressure, right, on inflation, right? Because I think right now primarily a lot of the supply side hiccups from COVID have largely resolved themselves, and I think a lot of what's driving inflation now are wages, which are continuing to go up and be successful in going up. I know Dork printed that Fred chart that showed a weak wage print relative to spending. Um, I would be interested to see how that trend continues. I think it'll probably tick up again.
Me too. Yeah, I just
Um,
want to point that out more than anything else.
yeah, and so you have this, this wage pressure, which I think is, not only just from international rising living standards, but also just long-term demographic shifts, like the boomers are retiring, right? And they own something ridiculous like 60 to 80% of all the wealth in the US, and they're all now retiring and they need services.
Yeah,
And they're not producing, right? And so I see this as potentially a much longer term shift in terms of, productivity down, costs up. And you couple that with a completely neutered and, you know, incapable government that's riddled in debt already while conditions are relatively okay. I don't see a good long-term outcome here without a lot of pain.
yeah, and so like I was gonna say, like to the end of it, it's not just the end of an era of cheap money, but it could be a transition into an era as well where the impact of deficit spending on economic growth is going to be damped, significantly. So the government's going to continue, so we have like right just to
Pickle
kind
Jar is
of
gonna
this
have
is a
to
little
get
bit.
so good at trading commodities.
Oh yeah. So like an example of this actually occurring right now is there is currently still a metric fuck ton of COVID stimulus money sitting in local governments that they can't possibly spend fast enough, right? They have a ton of money just sitting there that they're trying to offload. Like, we're talking like they're buying like fancy like 2x2 video wall screens for cafeterias and middle schools. Like they're trying to dump money wherever they can and they cannot dump it fast enough, right? So this I don't know if you call it a transfer function, but this sort of ability to just throw money at the economy and have it grow like you throw dollar bills at a stripper, I think is very quickly uh, evaporating. And we're going to see the government try as hard as they can to increase deficits to boost economic growth until the writing is on the wall that it's just not going to work anymore. And at that point, we're going to start seeing some actual austerity measures being taken.
I think broadly though, this isn't really like if we want to talk 10 to 15-year projections, I really don't think this is bad. I think we need it.
Absolutely.
I think we get an opportunity for the public to demand higher costs for their labor or higher wages, and we have on we're on the precipice of a large amount of wealth destruction, and we could really, much like the end of the golden age, we could really wrest back a lot of the control of that, provided that the populace is willing to come to an agreement on at least that front, that we deserve a greater stake of the economic growth that we facilitate. And if we can continue to press that point, as we have done really well, you're right, in the last 6 months or so, if we can continue to press that point over the next 5 or 6 years, as more and more wealth destruction occurs, and greater amounts of that like projected debt leverage growth reduce, the middle class could really come back and flourish, not just in the US but globally, because these are all so tied together. And so I do see good outcomes to all of this, right? It's something structurally I think we need desperately to continue to function as a peaceful society. There's other options, but obviously they're less favorable.
Absolutely. So yeah, so Sisyphus asked, wage growth has been low still, even with all the gains. If you
The last few years,
yeah. So I
it's
mean,
it's all
not necessarily. Wage growth in 2021 was pretty ridiculous. So like if you integrate the curve of wage growth, you get wages, and so there has been wage growth against inflation, um, pretty readily, but at the same time, all of this has still, like, even historically going back to, like, 2014 to now, all that wage growth against inflation has been predicated on our ability to keep prices stable, right? Or keep the value of our dollar stable, more importantly. So yeah, kinda, right? I mean, honestly, wage growth has not grown as much as it should have with the amount of stimulus we've been pumping in over the past 10 years or 15 years, but it has been there. Uh, it's just, the forward, like the tail risk to all that is what we're sort of experiencing now, where you have this dollar shortage, and that leads to volatility in the treasury market. Um, and ultimately, kind of what that will do is real incomes are probably not going to change much. Like, they'll be affected by unemployment, right? As the, median drops because people have to take jobs where they can, even though the wages of those jobs that they're taking aren't necessarily going to go down, right? So the real impact this has is on asset pricing, durable goods pricing, those sorts of things, at least in the short term. In the long term, we're looking at our trade deficits, rapidly shifting in how they're structured. Like right now, we're a net importer, but perhaps if we have, an issue where we can no longer use deficit spending to continue to stimulate economic growth, we'll probably end up shifting that away and be importing far less than we have over the past 15 years, right?
Yeah, I mean,
Uh,
I kind of see it a little bit differently. I don't think wages for most people have meaningfully increased in decades, at least in real terms. Um, and I think right now we're kind of having this fight where people see, hey, I'm in high demand. Uh, we're all in very high demand. We can strike and get what we want, or we can move and get what we want, because it's so apparent that there's a lot of demand. And the question becomes, well, we're not getting more productive, right? I mean, our productivity is flat. All of our GDP growth is coming from inflation, and so at some point, if you want to have higher wages without just creating more inflation, then it's a zero sum game. It's got to come from somewhere else, right? And so it has to come in the form of wealth redistribution.
Yep.
And that's kind of the fight that's occurring right now, is that the people who have everything are refusing to give it up, right? The value of the wealthy has gone up since all of this started, right?
Mhm.
And so at some point, somebody's going to have to eat shit. I know I say this all the time, but if you want to kill inflation, somebody has to eat shit. And hopefully it's the rich, but we'll see how it plays out. It's not usually what happens.
I will say, like fundamentally, that this may be our last shot to, like, I don't know. I probably fall more towards the other end of the scale, but I consider myself a poor. Um, this is kind of the last hurrah for capitalism. Probably this may be the last chance at any kind of fundamental redistribution of wealth, and for the first time since the 50s, the American consumer and the American laborer have the ability and the power, maybe even the leverage, to demand more and put corporations on the back foot where they need to fight for our dollar, which is something that hasn't happened since Nixon. Instead of fighting each other to make greater and greater profits, they really have to fight to get people to buy from them, to choose them, and that's a healthy capitalistic society. I mean, with the division in politics, I don't know if we'll ever get people to come to the agreement that that's something that we as Americans should have, or internationally even. But if we could end up in that position again, that's very sustainable for the long term, and it'd be really, really good for the vast majority of people.
Yeah, I mean, whether or not it's the last hurrah of capitalism, I mean, I kind of agree with what you like the underlying,
I mean,
I
we survived the robber barons, so there's that.
True.
right. Um, but like I see it almost as a there's gonna be there's a bifurcation of outcomes, right? Where we could end up, if we go back to ZERP one more time, right? Just one more hit, right?
I think it's over.
Yeah, I think, but the thing is we may think it's over because we're reasonable, but
Very true.
but to
Yeah, I could
people
see them
in
trying
power,
if things crash and they need to create liquidity to give it a shot. I don't think it'll be successful. I think they'll
Can they
just
yeah,
risk it though?
just like
Then they start to risk the long term value of the wealth they already have, right?
well, not only that, but they
Then
continue to
you're
risk
talking
the
about risking destabilization of the entire structure of what their wealth is built on. I don't think they take that risk. The robber
yeah.
barons didn't, right? They conceded. I don't think it would be different this time around.
yeah. Um, I just think this time around is different because there is much more at stake, right? In terms of these people, uh, and the the pain, right, and knowing it's gonna be there. There's a part of me, I'm always the guy who's the optimist about, consumers and things, and I love what Girk is saying, where supply and demand will actually make sense again. Well, at least the elasticity of supply and demand is going to make sense again. But I see a world where our politicians try again, and end up in doing so creating stagflation while they're also pressuring the Fed to loosen monetary conditions during stagflation.
The robber
That's the
barons.
that's my biggest fear, I think, is
Well,
that
I
something
know,
like that.
but you also stay up at night thinking about this and then watch the yield curve inversion in real time on the 1 minute chart. So I know where your anxiety is coming from, but I
Yeah,
mean,
well, I mean, but is it necessary? Like, it's not necessarily I mean, it's not necessarily founded. The idea that we could end up, in a situation like that It's just it's
I
worrisome.
agree, and yeah, that's like that's gonna lead down the more violent, nasty outcome, right? And obviously, like nobody wants that, and I think most of the people with wealth and power now are probably well aware of trying to replicate these conditions again, right? I mean, we've already got Fitch. We've got the Fitch downgrades, right? We've got S&P downgrading banks. Those rating agencies are good if they try to push up national debt in the face of this instead of allowing some actual wealth destruction. Like they know that they're not going to improve conditions in the long term, and not even that long of a term, like 5 to 10 years. We can be right back in the same situation, or and it'll be way worse.
Yeah,
Yeah,
well,
I mean, without the deflation of the ZERP era, from we basically exported our inflation to other countries, right? We can't really do that anymore, right? I mean, we're still trying to do that in Japan, and that's kind of one of the last vestiges. But I mean, even that's drying up. And once we can't export our inflation anymore, what are we left with? We're left with this massive debt that is itself inflationary, and the more the government tries to spend, the more they'll just kick up inflation. And I would hate for us to end up in one of these like South American or Central American country cycles where the debt is the inflation, and it
I mean,
just
that's where we'd be if we try to push
yeah.
debt higher right now. So everyone's like, I always see bulls say that, like, oh, it's okay, we'll just print more money. But we've
ah,
really structurally found ourselves in a place where we can't. We've
Yeah,
we've
I
printed
agree.
we've printed all the money that we feasibly can without broad destruction of our economic structure.
or at least our monetary structure. I mean, like
I mean, the
eventually,
monetary structure is already fucked.
yeah, like yeah, it's just it's one of those things where you're right, where if we continue to export inflation, the issue is that and BRICS, we joke it's a piece of shit, whatever, but faith in the dollar, if the dollar is actively destabilizing your government, like that's where the real danger shows up. I mean, we have nukes and everything, but if 3/4 of the globe has lost faith in your currency, like you can't nuke that away.
They still have to
Yeah, but
use it.
what's the currency that I mean, we've
We
had
just
this
we
discussion
just we just
before,
make a
and
new
there's
currency.
yeah, and it's not like we're doing vastly worse than most of the other. I mean, other people are doing worse than us, which is pretty much the only thing we
Which
have going for
that's
ourselves
what
right
that's
now.
what we've assured is mutually assured destruction, right, Torek? Not
Yeah,
through
but it's
not through nukes, but through economics.
right. But I love the dichotomy of you guys when we talk about how we can't have increased deficit spending create economic growth, but then on the same token, we talk about how like like when I say that the tail risk of printing too much money and exporting your inflation to extremes, destabilizes the faith in the dollar and its value as the exchange currency. All of a sudden, it's like, no, man, the dollar's cool.
Well,
Like
because
it's
It's
because
not
it is
necessarily the
because it's
dollar's cool, but like look at China. China, all this discussion of like BRICS or whatever. Like China's not creating a new international currency right now that everyone's going to join in on. They're fucked.
no, but there's gonna be one that shows up. One that makes more sense is gonna show up. And it's not
Who's
gonna
going to
be
make
like
it?
it's
Based
not
on whose economy?
probably Europe if I was to guess.
yeah, Europe
Eh,
would be the only competitor, and they're still relying on the euro dollar.
They are. The Eurodollar system is more important than just the dollar by itself. But I
Yeah,
mean, if Europe just decided to just peg to the dollar, right? Something like that, which they're already pretty close, but like
I mean
actually
they're
just straight
already
up pegging to
basically
it.
pegged. The euro's at like
Not,
107 to the dollar, right?
yeah,
I don't know.
but
I just don't see the European Union accomplishing anything with that level of coordination. They seem pretty discoordinated and unable to manage the swings in there, right? Because the European Union has, one big difference from us in that, our states are all sort of interconnected. The Fed has control over, each state, whereas with the European Union, they have much less control over the economic conditions in each
Yeah, the
state.
ECB is far more disjointed as a central bank.
Well, that's
Yeah.
all that takes though is ZERP 3.0, and then in 5 years, when their inflation is out of control, they have a summit and actually come to an agreement. That's all it takes.
I mean, we've so structurally insured the value of the dollar that even if we were to commit to debt destruction, which is we've had this conversation before, but even if we were to commit to debt destruction, the dollar would still, like, whatever currency came out of that would still be the international standard.
Yeah, that's true.
Too much of the debt that everyone's holding is ours.
It would be, but the new currency would be less dollar centric.
Sure. Okay, but it'll be ours. That's all that matters, right?
Yeah.
Oh, did we offend some Euros in the chat?
Probably not. They know.
Well, no. Frosted Flakes. Oh, sorry, you guys are doing so much better.
I mean,
think
yeah, because we exported
I
all
would
of
say
our debt to you and our core inflation.
I would say, without, I don't want to pick a fight. We're not doing so much better. The point is we're doing marginally better than everybody, at least to some degree, right?
Yeah, I mean, I don't. This is now we're talking kind of long term with all this stuff, but I agree with Gherkin in that, the wealth destruction is definitely the path of least resistance.
I would
But
say wealth destruction is the path of overall least pain, but it coalesces that pain around a very powerful, small and powerful group of people.
Yeah.
yeah, and that's the thing is, historically speaking, I mean, how often do powerful people allow that power to be wrested from them?
Pretty frequently throughout the course of history. But
Well,
they
when you
definitely
describe how that
they
happens,
they
though,
definitely fight back. Like, they're not a big fan of it. But they've
yeah,
been
no,
fighting back for 3 years now, right?
I mean 15.
Well, even more so in the last three. It's really
Yeah,
accelerated in the last three. But yeah, I mean, and they're not gaining the ground they need to, and meanwhile, the power they're letting slip is flowing into the hands of the proletariat, if you will. And once the proletariat has a leg up, they can take advantage of that for quite some time.
I think we
Turkish
also have the
communist
benefit.
firm.
I think we also have the benefit of all the billionaires in the U.S. are on Twitter now, so we all get to see
How fucking
firsthand.
stupid they are.
Yeah, we have a very intimate view into absolutely how stupid they are, and then you start asking the question of why does he have so much money? He's dumb as rocks. And then you look at what they did. You're like, well, they didn't really do a whole lot. Why do they have this much money? That goes a long way in terms of taking that money back, or getting that money to work more effectively in the society.
I will say
Yeah,
that
I mean,
Warren Buffett deserves every penny he has.
He does. I mean, what's the guy done? He did like the old school thing. He invested, right?
Me,
He
me,
actually.
me and Dork were talking about it the other night, and the fact that he bought up a bunch of like clearinghouses, like a bunch of stock and clearinghouses in Japan, knowing that everybody was going to run face first into the carry trade and increase the velocity of money. So remember that, like, on the mechanical level of cycling all of that debt through the Bank of Japan, you're creating millions and millions and millions of extra transactions with those dollars. And now Buffett's directly profiting. The dude's 92, and he's so fucking far ahead. Like, he's so far ahead of everyone else on Wall Street. It's insane. I love him.
Yeah, and there's no tricks, right? He literally played the long game. The guy's fucking 90.
Yeah.
All right, I think we've spent enough time talking about the economic outlook in 3 to 5 years. I think that the masses want to know puts or calls next week.
I want to go. I want to go with puts. I think the bull push dwindled out into the end of last week. I think they needed to pull back, and they need at least some call sellers to come in order to get more liquidity to the upside. So I think we get a continuation. I haven't seen any of the options data yet, so this is tentative.
Yeah,
But
I have to apologize. So everybody, I think we'll have options data fully updated by sometime tonight. I'm crunching 2.5 million extra contracts for us to get some goodies on. So a little delayed, but will give us much better data going forward. Yeah, so be excited. Don't be annoyed, please. I'm
so
working very hard to get you your data.
we love you, Jay Fresh. So yeah, I kind of think we're gonna we might see a retest, like a last ditch effort at gamma neutral, but I think ultimately these are gonna fail simply because there's no upside liquidity. And I think we're looking at least a small contraction this week. Maybe back into the like ES 70 or 60 range. I think they'll try to hold the greater amount of Vega risk out of the money. So 4450 through 4400 will be pretty heavily defended. But I think they need to let this slip a little if they have any hopes of getting it back above GM. I think they're going to need that liquidity to come in. And so I would say down in the early part of this 4-day session, and then maybe some stability into the end of the week. But ultimately trading in a slightly lower range between like SPX 4500 and 4450.
Yeah, so I mean, obviously I've been saying down for 2 weeks now, so I pretty much, it doesn't matter what I say at this point. Let's be honest. But I mean, what I can do is sort of provide my color based on the data that I see, and I'm looking at what drove this. I expected wild chop last week, and we kind of just got wild up and then wild chop. But the wild up, if you look at what drove that, a lot of it was just Apple, like literally just Apple. And then some of the other Mag 7. But what was really interesting was that the Mag 7 volatility was insane. I mean, you'd have some that were down 5%, some that were up 3% the same fucking day.
Yeah.
Meanwhile, Vol's crushing hard. So somebody's clearly trying to push on dispersion between those two things,
And I
with
think
varying
failing,
success.
right?
Yeah, and so, and if you look at sort of just like the market cap percent of the Mag 7 versus the S&P 500, they've pretty much returned us back to where we were when we were trying to hit 4,600. Yet here we are at 4510. So they're already losing ground in the overall market and losing the ability of the Mag 7 to continue to prop this up as as people in the Mag 7 are more and more prone to take some profits, or at least pull some risk off the table as these prices just soar. And we've kind of gotten almost back to the point we were in Jan 2021. So it's like, how much more room do these 7 stocks really have to run? I don't think there's much. So if the Mag 7 loses enough ground and pulls back this week, I mean, we could go to 4,300. Now, obviously, that's a huge drop. And would probably need to be facilitated by some sort of macro news, which is unlikely to happen this week. So I think based on all of that, I'm kind of, I'd love to see 4,400, but 4,450 would be okay. I would be surprised if we got over 4,550, although I could see us trying to push back up into like 4,530-ish and then just sticking around there for a while before dropping. But
All right.
Dork.
So my prediction is we got our first test of gamma neutral. It didn't go so hot. I kind of figured like, so last week I said we would go down on the data print, but that was just because I'm bearish and I have a moral obligation to say the data is going to be bearish. The data was bearish, but then we pumped into our gamma neutral test. It went not so great. We didn't break through it, but I think there's still going to be one solid push, like a concentrated effort to get above gamma neutral, to just get that market maker support. If the bull run is to continue, it needs to happen. So I think that if there was a time for it, it'll be this coming week or the next, and I would expect it to happen sooner rather than later. So retest gamma neutral with a good amount of momentum on Tuesday. Monday probably flat or down. Tuesday big push up, and then Wednesday, Thursday, depending on whether or not gamma neutral is breached. If it's rejected again, I think if it's rejected again, you guys are right. We're gonna drop pretty precipitously. But if it breaks through, then yeah, we're just gonna chop and have shitty price action. So my final, because I'm bearish and I have a moral obligation to say it, we're gonna get rejected off gamma neutral, and then we're gonna go down another 100 basis points by the end of the week at least.
Yeah, okay. I don't. I mean, I think me and you were kind of on the same page then.
Yeah, even
Yeah.
JFresh kind of he has echoing sentiment as
I
well.
mean, this is
Yeah.
we're really at a point where we've sort of separated so far from both fundamentals and now technicals and macro that it becomes really difficult to see where this shakes out, right? I mean, there's just so much movement that is so against all of those three things that we're kind of just in almost a chaotic environment.
I mean, we are, but I mean, this is kind of how I see both sides of your coin. Like, at least how I'm thinking about the analysis for this week, is that yes, they want to regain GN, but above GN is weak. They don't
Yeah.
they don't have the liquidity, and they don't have the call structure after Friday. So I don't think a test of GN is out of the question, but it'll be weak. And they would actually be better off pulling back to fast gamma, letting some call sellers come in, and then trying to reverse in the latter half of the week. Just because, and without that liquidity, there's just not that much higher they can go. And if they do let it drop, they can get GN to fall a little bit, get it down to like the 4,500 level where they can get a lot more leverage.
They need gamma. They're working against gamma. They need to use it to their advantage. But.
So I think like, yeah, Dork's probably right. There's gonna be a test. I think you're probably right that we're gonna fall down to like at least like the front weighted gamma neutral, maybe even just here's the problem. If we hit 4,450, there's a big fat fucking pile of long puts
I
and
would
short
love to
puts.
go lower. I'm just
Well, if we hit 4,450, we're probably going to 4,400. So they need to preserve 50, I think. If they're able to preserve 50, they'll retest and push back up above. If they fail 50, we're going down to 4,400 by the end of the week. And I'll clarify that as I get more data from you, but I think you're both right in a way. So yeah, I think maybe we're all kind of essentially in agreement with maybe the dates being off a little bit.
Gork, can you entertain me for a second and pull up the 5-day on Nvidia.
Yeah.
And just kind of zoom into the last few days. Yeah. So can you show us on the chart where you bought puts?
Yeah.
And then can you circle the big red drop at open on Friday? Yeah, so the first two circles are where Kirk bought puts, and the last circle is where Jensen Huang sold almost $120 million worth of shares. I can't think of a better timed play than that. It's just, I don't know. I was thinking about it the other day. It's just what a beautifully timed play. You front ran the CEO of the company.
I also bought calls on it
Congratulations.
last week from here. So I bought calls there, puts here. It's been Nvidia's getting easy. And it moves enough that it's profitable. But I think everyone was in on the beginning of the week Nvidia play. I wrote about it. I wrote
Yeah, I
it
know.
up.
I
Yeah.
saw it. I didn't play it, but I was
Yeah.
Playing Nvidia is fucking expensive though.
So I hope it keeps going
Yeah.
down though, because the puts I bought may or may not be concentrated around 480. So I still need, as great as the play is, I still need that $5 more. I think they're
Come
up,
on.
but
Come on, Twitter conspiracy theorists, we can do this.
Whole other tangent we can go into with all that.
Yeah,
shit
we don't
too.
have to. But yeah,
I'm not gonna
I mean,
lie though. The first test I was pretty scared of selling puts on though, because I thought, what if the 500 like short calls pull back? Because then it would have ripped to like 560.
yeah, there's a lot of calls on the chain, and it's hard
Yeah.
to tell what fraction of them were bought or sold, and they're like all the way up to like 800. It's ridiculous.
Stupid prices. Yeah.
I mean, we really need. I mean, if we want the SPX to really crater, we need 3 or 4 of the Mag 7 to shit the bed to some degree. I mean, it'd be great if Apple reversed. I don't know how much farther it has to go, but actually, could you do some TA on Apple real quick?
Yeah.
I mean, that's probably going to be super important this week. How much higher could it go, or is it just going to start?
Failed. I mean, I think a pullback to, or sorry, that's Amazon, Apple.
Because I think, I mean, a lot of this is supposedly the iPhone 15 hype. I don't know how often this happens. I mean, I can't imagine who's that hyped about an iPhone at this point, but.
When was my long entry on Apple? I think it was Monday, last Monday.
Yeah, it was Monday. And then it like rocket it, yeah, because it had that weird spike at the beginning.
No. I think it was the midweek. I think I entered here, and then I cut because I know I cut them the same day, and then went long again at 87.20 or 87.50, 92.50. Yeah. Those have sucked. Like that debit spread, it's up, but it's been like the returns on it are like 27%. They're dog shit. Yeah, this is bearish. Like, yeah, I mean, if I zoom out on this, like, this is not good. Like the fact that it didn't quickly regain this level and it started to stagnate here. If it fails this lower resistance at 190 and starts to drop, that's gonna fucking come like all the way back down to 180.
Well, we needed to go back to 170.
So this week I'm probably this week I'm probably gonna flip short Apple. The problem I have with Apple and going short on it is that once call side momentum builds on Apple, it takes forever to unwind, like days and days and days. So like even though this is bearish, yeah, even though this is bearish, like this could continue to just be an asshole for like 3 weeks before actually falling. Like
Yeah,
we need
I
like
don't know. I
30
just
30
don't
DTE
see.
of calls off the chain before anything really gets bearish, like super
I
bearish on Apple.
see that sort of makes me pause about my prediction that the market's going to go down, because I just don't see how this market can go down without Apple going down
It
too.
can go down without Apple going down. It did before, right? Apple definitely accelerates any drop in the market, but if Microsoft, Google, and Microsoft, Google, Netflix, and Amazon have bad weeks, that can ignore the effect of Apple rising.
Yeah, it's hard to fight against Apple though.
It is, yeah.
All right.
But
Well,
Microsoft can. Also,
yeah,
the other
Microsoft
issue
hasn't been
there
doing
though is
well.
that oil is on the uptick, and that's going to provide stability to the S&P because of the 10% energy allocation.
Yeah, very
Um,
true.
so
Although it
don't
seems like
forget
on futures,
don't forget Zom and Chevron adding some tailwinds.
although on futures it still looks like it's tech's world and we're all just living in it.
We,
Brent's testing nine.
we
Brent's
also
testing
we also want to
90 in
see
Dows.
yields continue up. This is probably more bearish immediately than anything. Is a continuation of yields to the upside, and dollar value up over 104.50. I think that's like our local. So we want to see dollar move up about 100 BPS to get real fucking bearish.
So close.
Yeah, we are.
We need a. It's been way too long since a regional bank failed. We need a regional bank failure.
Maybe soon. Who's it gonna be though? Why
Schwab.
does it? Why does it have to be a
Schwab,
region?
yeah.
No, Schwab's not failing.
Schwab.
As much as I dislike them, I was long Schwab, and then their earnings were amazing, so I sold everything.
Well,
But
I heard a rumor. I heard a rumor that the Fed sent some like liquidity warnings to some regionals, and I'm trying to remember which ones they were. I know one was Fifth Third Bank because
yeah,
I know
I
we
would
talked
say it's
before.
probably Wall, Fifth Third, Key.
It might have Key might have been on that list. I don't remember. I'll have to try and dig it up.
Wells. If the Fed was sending out notices to Wells about deposit requirements, everybody in the world would know about it already. They'd
Yeah,
probably
that'd
keep
be a
that
good idea.
correspondence pretty muted, given that they're a GSIB.
So yeah, we could use. We need something to just fail this week. It feels like a good week for it to happen.
If we do continue to see an increase in VIX this week, remember the debit spreads tend to be better in an increasing volatility environment than credit spreads. Um, Choose your ranges wisely, but and then straddles are still just awesome.
Yeah, that's another thing that worried me as well was the VIX. I'm glad to see that the VIX is showing some signs of life in the futures market before open tomorrow, but I would look at there's a risk that we will open high, right? Just
Yeah, and they'll
because
use they'll use crushing VIX to get their retest of Geo. That's
that
what I
t-
was
so
thinking.
that tends to be what happens like on days where the price action and the VIX strongly deviate. They tend to resolve themselves the following morning, like when SPX opens early in the pre-market. And if that happens here, we're looking at like a 45-30 ish open tomorrow,
Where
which
we're at
hopefully we,
where
we
we're
won't
at right
see.
now.
Yeah.
This is right now. ES is at like SPX 45.15.
Oh, that's good then.
Yeah.
If yeah, that's what I'm saying. If the VIX futures are recovering nicely, that could prevent that melt up. But I mean, we've all been watching these ridiculous futures melt ups, and I think a lot of that is from
I see. I
VIX.
think I think if we open on high VIX, they short it and try to pump.
Yeah, so I mean, either way, either we're gonna
Yeah.
open low and pump, or we're gonna open high and.
I would actually prefer, for the downside, I would prefer VIX open around here, and that we don't get increases on VIX till we fall below like the big Vegas strikes, like 4,500 and 4,475. Because these will bump VIX up, but not in a way that's beneficial for the bulls. If we have like, if we open at like 4,500 on like VIX like 1450, I think they short the ever loving fuck out of it and try to pump.
I mean, bottom line, I think we just need selling on the Mag 7. We need people to sell the Mag 7.
All right.
If they do that, everything unwinds and we go down. If people continue to hold and buy and YOLO, same shit, different week.
A while back, Kirk's like, I think 110 is the top on TSM. It was, and Buffett sold the next day. Buffett's a Dillionaire, obviously. Could you hit a quick 30-second QQQ straddle tip? So when the option's green, that's when you want to sell it. Ideally, it's green, like it's up more than the cost of the opposing leg. And then you really want to sell it. And then the other leg you don't care about, but sometimes it turns green too, and that's just the best.
That's how straddle works.
Yep. Management of a straddle, it takes time, but the better you get at understanding the trading range, the more you can extract profits from them. I would say as a beginner, though, most of your straddles are probably going to be closing both legs at the same time for, 8 to 20% profits, which is still great. We're not in a stagnant market yet, so they're still profitable overnight. But as you get better at that, you will learn where the peaks and the lows in a trading range are, and you will try to exit your straddle at both of those points, in which case you can double or quadruple those profits. All right, that's enough. We've been here too long talking about too much shit. Thank you guys so much for coming on. I think over the next few weeks we might have some bigger announcements for you guys with some stuff that we're working on, which could be exciting for everybody.
Now you're just putting all this pressure on us to perform.
Yeah. Well, at least perform to a minimum viable standard.
You bastard.
But
expectations.
Yep,
you, Gert.
I know. But thank you guys for coming on. I appreciate it as always. It's good having you guys on.
Yeah,
thanks for having us, man.
Always fun.
I'll see you guys around later. Also, JFresh, let me know when you get the data up.
Yep, I will do. I
right.
have another couple hours, I think, but we're getting there.
Cool.
500,000 more IVs to crunch.
Oh, Jesus.
That's not much.
Hey, it was 2.6 million just 36 hours ago.
Okay, well that's Jesus.
Sometime tonight.
What was it? All the historic 0 DTE data for end of day?
Yeah, all
is
the
that
end
what
of
the
day.
Okay.
Basically weeklies on SPX. Yeah.
Okay. Well, that's cool. That should improve our accuracy, I guess.
It'll be awesome. Yeah.
Yeah.
Over half a gig of data. So.
What's that, Torque?
I'm more excited for the deep fakes to come out that Big Spoon's been working on. He's been crunching some numbers too.
Oh fuck, that's gonna be awesome. I can't even use GIFs that don't feature me now. It's completely taken over my ability to I now have to scour through all the GIFs that I'm in to find the fitting one, because other ones just they don't have that touch.
When are we gonna get our hands on some H100s? We need it for the number crunching.
Didn't you? I told you guys to get in contact with CoreWeave this week and see what kind of discounts they're really willing to offer.
They were willing to offer me a bunch of Tesla cars. They didn't offer me any H100s.
Sounds like Dan work.
Yeah, it does sound like Dan work. Get one of the Dans on it. They can handle that. All right, guys. I'll see you later. Have a good night.
All right.
Yeah.
Yep. Bye.
All right, everyone else, thank you so much for tuning in. If you guys have any questions that I didn't get to, feel free to DM me. I'll probably be around for most of the rest of the day. As always, appreciate you guys tuning in, and I will see you tomorrow. Pickle's Picks will be out tonight, probably late, but make sure you look for them in the morning if you don't see them tonight. Have a good night, guys.